Welcome to this edition of Feeley Driscoll's videocast. This is the first segment of a three-part series entitled Managing Fraud Risk in Your Organization. In the first part of this series, we're going to discuss common fraud risks within organizations, and then we're going to move into cash disbursements, which is probably the number one fraud area for small and mid-sized organizations. My name is Mike Downey, and I'm an audit director with Feeley Driscoll. Common fraud risks at small and mid-sized organizations can range depending on the economy, employee situations, etc. The following is a list of common fraud risks that appear time and time again in instances where fraud has occurred for mid-sized organizations. The first, long-time employees granted excess power over finance. Generally speaking, no employer believes that fraud will happen with them. When we discuss fraud risks with clients, a common theme is that it could not happen to them because the individual charged with finance has been with the organization for X number of years and would never steal from the organization. As a result, that individual is granted power over finances, and ownership gives them more and more leeway to handle the finances on their own. Generally speaking, when a fraud is committed, an individual had excess power over finances without ownership oversight. On the flip side, substantial employee turnover, particularly within the finance department, can cause confusion and can mask fraud or theft. Over the past few years, as the economy has suffered, a number of clients have cut overhead within the office and particularly within the finance departments. This has left a gap in the oversight over finances and the controls in place to minimize theft and fraud. That leads us to our next common fraud risk, which is an understaffed finance department. Internal controls do not necessarily go hand in hand with the number of bodies within a finance department. However, as cuts are made and the number of individuals within the finance department decreases, corresponding controls must be implemented to make up for the fact that the finance department has eroded. In a number of organizations, these controls have not necessarily been implemented to make up for the fact that people have left the organization. The next two items, changes in outside personal situation. This may not necessarily be an extreme instance. A change in outside personal situation may be as simple as a child going to college, in which case an individual's income has essentially been cut, or their expendable cash has been cut to the tune of $30,000, $40,000, $50,000 a year in college tuition. That is an extreme change in an outside personal situation that can give rise to theft or fraud. In the same vein, the lifestyle of employees, gambling, drug use, alcohol abuse, etc., is one of the most common themes when fraud is committed. Additionally, evident changes in the lifestyle of employees, such as new cars, houses, vacations, boats, etc., can also be an indication that fraud is being committed. Lastly, to go along with what we had discussed earlier, the economy has caused a number of employees to either freeze or decrease pay. This can lead to justification by employees that after a number of years without a pay raise, that they are entitled to additional compensation. In this event, they may take matters into their own hands and compensate through fraud or theft. Lastly, over-reliance on CPA firm. What this is referring to is in a number of instances where organizations are relying on the outside public accounting firm that prepares their tax returns or a review-level financial statement to detect any fraud. In most instances, when we're performing any services outside of an audit, the level of inspection of the financial records is not such that most frauds would be detected. Without fail, when a fraud is detected, most organizations look to the accounting firm and ask the question, why was this not discovered? Without a financial statement audit, and even with a financial statement audit, the CPA firm will be hard-pressed to discover most frauds that occur within small and mid-sized organizations. Moving forward, the bulk of fraud within small and mid-sized organization takes place in the cash disbursement area. There are certain controls that may be implemented to minimize or even eliminate the risk of fraud as it relates to cash disbursements. The first item is separation of duties between the authority to sign checks, the individual that processes transactions, cash disbursement transactions, and lastly, the individual that performs the bank reconciliation. In many small, mid-sized organizations, it's not possible to completely separate these duties because of a small finance department, perhaps one individual in total. Therefore, there are certain controls that may be implemented in order to minimize the risk of fraud, even though these duties are not adequately separated. Secondly, more and more vendors now are beginning to require payment via a wire transfer or a cash transfer. Within the bank statement, these transfers show up, in a lot of instances, just show the account number to the organization where the cash was transferred. Most banks will provide either an email or a phone call when a bank transfer is initiated. This prevents from transfers to either individuals or vendors that are not approved by ownership. Copying check fraud, we see more and more where there are physical checks that third parties get their hands on those checks, make copies of the checks, and then use them successfully, cashing the checks. These are usually for small amounts. Positive pay is offered by most banks as a way to prevent against copied checks being cashed. Also, in a lot of instances, these frauds are actually picked up by the banks before they can get too far. Positive pay does require a good amount of time, effort, and energy within the finance department to be able to generate a list of checks that are being cut for that day to ensure that the bank knows which checks have been authorized to cash. As far as dual signatures over a certain amount of money, this prevents from what I like to refer to as fly away to the Caribbean fraud. So in other words, dual signatures simply makes it less likely that an individual will try to cut themselves a very large check and take it to the Cayman Islands. This does not necessarily prevent it. Anytime that this does leave open the window for an individual to forge the signatures on the check, however, it does give them pause before they attempt that. The most common cash disbursement fraud vehicle is the next item, where the individual that does have control over cash disbursements as well as control over processing the transactions simply writes checks to either themselves or to fictitious vendors and then pulls the bad checks from the bank statement at the end of the month before giving the bank statement to ownership. For clients or organizations that utilize QuickBooks, an individual can cut a check to themselves, cash the check, go back into QuickBooks and change the payee to one of the more common vendors. And if those checks are then pulled from the bank statement at the end of the month, whomever is reviewing the bank statement will not necessarily uncover that theft. A very simple control over this is that ownership should have access to either unopened or online bank statements and should review those every single month. Any checks that are cut to unknown vendors or to individuals should be questioned at that point in time. This will prevent the ability to cut checks, as well as most individuals will be deterred from even attempting this type of fraud when they know that ownership is reviewing the checks at the end of each month. Blank check access is something that is pretty self-explanatory, that wherever your check stock is, that should be under lock and key so that employees are unable to access it. And more as people move towards online banking, so shouldn't PIN numbers be protected. I have been to a number of clients where they're utilizing online banking and the individual that accesses the bank account has a sticky note on their screen with their username and their PIN. This is not the protection over the PIN numbers that would obviously effectively prevent somebody else from accessing the account. And lastly, in the same vein that individuals that we need to protect the PIN numbers such that individuals can't access the account, a lot of times the actual physical computer that is used by that individual may have a password already stored in it, so that if somebody is able to access that computer and go to the online banking page, the password is automatically entered. So therefore, just the actual access to that individual's computer should also be protected as well. In the next segment of this webcast, we're going to be discussing payroll risks as well as accounts receivable and cash receipt risk and how to minimize fraud in those areas. If you think that you or your organization may be subject to fraud or to evaluate your organization's susceptibility to fraud, please contact our office at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you.